Hi friends, my name is Amandeep Singh and I am a CPA at Cloudiverse CPAs. One of the most frequently asked questions from entrepreneurs is whether they should incorporate or not. While incorporating is good for some, not all businesses will necessarily benefit from a corporate structure. Failing to plan is planning to fail. If you are considering incorporating your business, you should take the time to watch this video about the possible advantages and disadvantages of incorporation and plan the structure of your organization accordingly. Let's start with the advantages of incorporation of your business. There are several potential advantages to incorporating your business. Number one, lower tax on corporate profits. From a tax point of view, incorporating your business can be very beneficial, especially if your business has reached a steady, profitable level, meaning that you have enough of an income to offset the cost and are able to set aside a portion of your business earnings in the corporation. The purpose of this is to be able to benefit from a lower corporate tax and achieve significant tax savings. Your corporate profits will be taxed at a much lower rate in comparison to your personal income, unless and until you decide to pay yourself a salary or a dividend or a bonus. So if you need a substantial portion of your business income to fund your annual living expenses and meet your financial goals, incorporation might not be the best idea because you're going to withdraw that money as salary or dividend and pay personal taxes on it. Number second, lifetime capital gains exemption, which is also called LCGE. You may enjoy a significant tax savings on the capital gains realized on the sale of your company shares, which might qualify as the shares of a qualified small business corporation. I know that the lifetime capital gain exemptions sound super nerdy and super boring, but I can guarantee you it will save you money. This tax advantage alone can make it worthwhile to consider incorporation. Wait a minute, are you thinking that I'm still trying to earn my first dollar? Selling my company is the last thing on my mind. And I don't even know if I would want to ever sell my baby, which is my company. But here's the thing. Even if you build a business with zero intention of selling it for a big payday, and even if you never do actually sell, you should still build your business as if you are going to sell it someday. What is the benefit of that? Well, building your business using the lens of how an outside investor would view it will do wonders for your company's value and integrity, no matter what your end goal may be. So, when you ultimately decide to sell the shares of your company, which might be a qualified small business corporation, the lifetime capital gains exemption might shelter 800,000 worth of gains. For example, when you create a company initially and you put, let's say, $100 worth of value, the company grows over the years and finally you sell the shares for $1 million. 800,000 of the gains is tax exempt. And the best thing is, it is available on a per shareholder basis. So if you set up a corporation, maybe you have a partner, a husband, or a wife shareholder, they get 800,000 exemption as well. That's right. Boom. 800,000 to you, 800,000 to your wife. Please remember that you have to sell the shares of a company and not the assets. And also, you can only claim this exemption once in your lifetime. So you only have one kick at the can. The lifetime capital gain exemption was increased in 2014 to 800,000 for dispositions of qualified small business corporation shares. After that, it is always indexed. So you can find the current year lifetime capital gain exemption from the CRA's website as well to get the right number. Again, each individual's resident in Canada can claim LCGE exemptions on the capital gains on the disposition of qualified small business corporation shares. Number 3, flexibility in remuneration. By incorporating your business, you gain access to use a combination of different forms of remuneration. So you can pay yourself in many different ways. This can include salary, bonuses, and dividends. The ability to choose the type and the amount of remuneration may allow you to maximize tax deferral and achieve tax savings while still taking advantages of benefits such as creating a registered retirement saving plan contribution room, which also saves you taxes. It also helps you in participating in the Canada Pension Plan or the Quebec Pension Plan. For more information on this topic, watch my video on salaries versus dividend. Number 4, increase in business and better access to raising capital. Having LTD, INC, or Corp as part of your company's name may increase your business. Now you may ask how? Well, people perceive corporations as being more stable than unincorporated businesses. If you are a contractor, you may also find that some companies will only do business with incorporated companies because of liability issues or the wish to have more of an arm's length relationship with you. For more information, watch my video on the risk of being declared as a personal services business. If your business is expanding and it needs more money to operate successfully, incorporating your business may make sense for you, since raising money is often easier for corporations rather than the sole proprietorship as compared to the sole proprietorship or even partnership. Number 5, income splitting. The new tax on split income rules have restricted the corporation's ability to income split. However, corporations still allow you to pay reasonable salaries to your family members for the services they provide. This strategy allows you to take advantage of your family members' lower marginal tax rates while generating RRSP contribution room for them at the same time. So you kill 2 birds with 1 stone. Your corporation can claim a deduction for the salaries paid to family members as well. You can also use dividends for income splitting, but you need to be very careful, as the process of making a family member a shareholder of your corporation is complex and may result in immediate tax consequences for you. Number 6, continuous existence. If you operated your business as a sole proprietor or a partnership, your business would cease to exist, I'm sorry to say, on your death. On the other hand, if you incorporated, your corporation would continue to exist even if every shareholder and director were to die. Your corporation would not have to be wound up. Incorporating your business sounds like a great idea, doesn't it? But there are also disadvantages that you need to consider. What are these disadvantages? Number 1, another tax return. Incorporated entities must file more paperwork, such as separate tax returns, which are the corporate and the personal tax returns, one-time articles of incorporation, which you have to file with the registrar of companies. You also have to file the notifications of share sales, moves or changes of directors with the registrar of companies. Number 2, no personal tax credits. Another disadvantage of incorporating is that being incorporated may actually be a tax disadvantage for your business. Corporations are not eligible for personal tax credit. Every dollar a corporation earns is taxed. As a sole proprietor, you may be able to claim tax credit a corporation cannot claim. Number 3, less tax flexibility. Well, as a sole proprietor, you could use the loss to reduce other types of personal income in the year the losses occur. For example, if you are working on building a business as a side gig while having an employment income and your side business as a loss, you can set it off against your employment income and save taxes. In a corporation, these losses can only be carried forward or back to reduce the corporation's income from other years. If you run an incorporated business at a loss and then shut it down, you cannot claim the business losses personally. They are gone. All you can claim is the money you lent or invested in the business as stock or loans. Number 4, liability may not be as limited as you think. The prime advantage of incorporating limited liability may be undercut by personal guarantees and or credit agreements. You see, the corporation's much wanted limited liability is irrelevant as no one will give the corporation credit. When a corporation has what the banking institution call insufficient assets to secure debt financing, guess what happens? The bank will often insist on personal guarantees from the business owners. So although technically the corporation has limited liability, you might still end up being personally liable if the corporation can't meet its repayment obligations. Number 5, registering a corporation is relatively expensive. A further disadvantage of incorporating is higher accounting and legal costs, as corporations are more expensive to set up and maintain. A corporation is a more complex legal structure than a sole proprietorship. In fact, it's a separate legal entity, so it's logical that creating one would be more complicated and costly. Closing a corporation is more difficult. After learning about the disadvantages, you might want to change the structure of your organization and close the corporation to switch back to the sole proprietorship status again. But please bear in mind that you will have to pay legal and accounting costs, as this requires a number of legal and accounting formalities to dissolve the corporation, such as winding a payroll account, sending a copy of the certificate of dissolution to the Canada Revenue Agency, filing a corporate tax return for the stub period, etc. Don't forget that the form of business ownership isn't set in stone. You can always change the legal structure of your business as it grows. Many businesses are in losses in the very first few years as a startup business. So business with anticipated losses and little legal risk can really start as a sole proprietorship, but increased risk and more significant earnings will favor incorporating at a later stage. Common scenario is for small business to start out as a sole proprietorship or as a partnership and become incorporated at some later date when the business has grown. It will be very useful if you consult your CPA and your lawyer to ensure that you have taken into account all of your considerations before deciding whether or not to incorporate. I hope you enjoyed this video. Don't forget to subscribe, comment, and like our YouTube channel. See you soon, and thanks for watching.